Well, gentlemen, thanks for joining me on the floor here of the MedTech Conference in San Diego 2025.
Pleasure to be here, Joe. Thanks.
Always good. You and I get
Always
together,
good.
try and get together every year. You've got the big
Yeah.
report you drop right before the show, and Scott, you and I always have a chance to catch up here as well. Subject du jour that doesn't get enough coverage. You and I have been beating the drum for a while. You have been beating it too. Ambulatory surgical centers and MedTech.
Yeah.
And how it affects the patient, how it affects the provider, and how it affects the manufacturers. So what were some of the observations from the report you released?
So we really focused on 5 vectors that are impacting medtech broadly. And what we've been doing a lot of research over the last year is for public companies, what really drives total shareholder return. And we found more than anything, really the capital allocation strategy, so investing in R&D, investing in M&A, tends to be the leading factor that impacts and drives the companies that outperform from a total shareholder return perspective. And so when you think of how does that relate to the topic here on ASCs, it's really around investing in the business, in technology, in AI, to really enable care, all the technology, the devices, the capabilities to treat patients in a lower acuity setting. And so, there's been a lot of progress in orthopedics. I know we're going to talk about that today. I think there's going to be a further migration on the interventional cardiology side with some of the capacity constraints in acute care settings. And so, I think that's one of the big vectors that was in our report this year that really has applicability for what we're going to talk about here today with ASCs.
And Scott, you've spent probably more time than most MedTech professionals, and you were an operator in the past as well, and especially focused on the ASC market. What do you see happening and the industry not responding to right now in that ASC setting?
I think it's a great question, because I think the industry has been for decades using the same playbook that they have for the hospital-based customer. And when you think about the ambulatory center customer, you have to recalibrate yourself and your commercial team and your product development team that this is 95% of ambulatory centers are for-profit businesses. They have shareholders, they have profit distributions. And it's not having added bells and whistles in technology that has no economic downstream revenue. It's being very conscious and deliberate about developing technology that has value add for those owners. And it's not all about price. Just working with both ASC management companies as well as big medtech clients, you can come with a new service line that you can drop into an SCA Health or a USPI that is a premium price technology, but behind it is a real pro forma that is proven. And you better have your numbers right, because, oh, by the way, most of these entities are now either private equity backed or have private equity doctors in them, because it's part of that PE thesis that they're investing into MSOs.
Yeah, and so you bring up an interesting point is you've got to bring the tech, but we have watched the tech prices continue to go up and up, the inverse of Moore's Law. It's supposed to get cheaper and cheaper over time, and those good enough feature, let's call it average products. How does a surgeon think about them when they're coming from a hospital with a full feature deck? So I'm on a DV5, right, a Da Vinci 5, and then I slide over and I'm working on another system that's good enough, right? So how do you make the numbers work there? Is it a different pricing model?
Typically, it's been a different device altogether that still enables that care-specific setting. It's designed for smaller operating rooms. They don't have the big, or bigger settings. So typically, it's going to be just a different feature set. I think the one thing that is probably going to benefit ASCs the most is that there are a number of multiple robotics, approvals that have gotten significant funding over the last several years, where that miniaturization to bring them into ASC settings is really going to happen. So I think you're going to see that happen. There are also robots now being designed for specific procedures, and those typically are much smaller than a Da Vinci 5. And so with those, I think you're going to see a number of specific procedures really move in that care setting that again can be served in that less acute setting.
When we think about mid and low acuity, we're looking at a much higher volume as well, right? And we're looking at a high acuity, highly complex case. Usually the dollar value for the hospital is much greater. So if we can pull those procedures, those mid-low acuity out and put them into an ASC, it frees it up for a higher value profit per case in the hospital. So everybody's winning here, but where is the friction?
I think the friction, one, is understanding the realities of operating budgets in an ambulatory center. We've gone through an extraordinary period of wage inflation with healthcare workers. You have a shortage of providers as well, whether that's a nurse anesthetist, anesthesiologist, or a subspecialist. And at the same time, your drugs, your PPE, and all the equipment that you use are also going up, while reimbursement is pretty much staying stagnant. So it's looking at ways to reduce the risk of adoption for ambulatory centers, which really lends itself to a per-click type model, which you're seeing right now in some of the new soft tissue robotic platforms. I would say, one of the other things that I don't see enough med techs focused on is the FTE count for your procedure, meaning that if you have an OR that for a Da Vinci case, or the setup for a Da Vinci case that may take 45 minutes, that block time is not feasible for an ambulatory center because of the churn and how you're trying to optimize your schedule. So setup time matters, FTE time matters, and then case consistency matters as well, meaning that if you're doing a cholecystectomy, you can't have a variability of 30, 40 minutes. You want to have it block time at maybe 45 minutes, and then 15 minutes to turn over that room for the next case. These are focus factories, and having the experience and really the honor to be an operator in an ASC management company, that's what keeps you up at night, is your staffing, your overtime costs, and your labor. It's not the devices, I hate to say. It's, we all think that, within the medtech community, the sun rises and sets around this device ecosystem. First and foremost, it's your people. And, that's your biggest cost.
Well, if all you do is make devices, that's what you think of all day long. But to your point, the FTE, so the largest cost in an ASC is labor. And then the culture in an ASC is entirely different than the culture in a hospital. It's almost comparative to you work in a big strategic or you work in a startup. You were built for one, but you can't be built for both. So that's also a challenge right now. Did staffing come up at all from an ASC perspective in the report?
So staffing from an ASC perspective, no, but definitely one of the things that we heard time and time again is MedTech focused on increasing throughput, whether it's an acute care hospital or regardless of care setting. How do you literally more efficiently and frankly more autonomously treat patients throughout the system? And I think it really comes back to enabling that dynamic so that employees can be the more proficient. Just like you and I use ChatGTP and Copilot to be more efficient. They need to use their medical technologies to better triage, more efficient, free up, and have more time to focus on actual, treating patients. Back to the point on, capacity, I do think that there will be an element of segmentation, especially as you look at interventional cardiology. We've done some research on the space. About a year ago, this whole capacity issue kind of bubbled to the surface in the interventional cardiology suite. We actually kind of verified that was/is an issue. And so, they have a preference for, surprise, surprise, doing the procedures that tend to generate the most physician compensation, both from a time, effort, and procedure perspective. So being able to kind of free up capacity there, whether it's PFA or some maybe mitral clip or other procedures, so that the time in the interventional cardiology suite is really focused on the most riskiest procedures, those requiring backup just in case, really makes a lot of sense. And I think as you look at maybe some of the partnerships with facilities and ASCs, you'll see some of that segmentation bear out and really kind of be the proving ground of which procedures kind of get done in which care settings.
I've had a thesis for the last 2 or 3 years, and I'm curious both your perspectives on this. Let's call it the entropy that occurs in a standard hospital setting is pretty substantial. However, the ASC is more likely to have a more agile environment, a different employee, different motivation on the clinician, ownership as well, where AI probably has a better chance of getting traction, maybe from a workflow perspective, efficiency perspective, and to reduce the overhead of FTEs, full-time employees in there. And then that will then prove its point in the ASC model, and then eventually get the adoption by requirement in the hospital, because the hospital is going to get its lunch handed to them if ASCs take too much of the business away. Thoughts on that?
One area that, as an operator in the ASC environment, that was a total learning for me, but it's so critical to your profitability, is rev cycle management. Capturing the work that's being performed in the ambulatory center, and this is more than a reimbursement guide. This is the charge masters. This is capturing not just the CPT code, but all the modifiers that go onto the CPT code. What I think right now is one of the biggest opportunities for a med tech company that's entering and investing in AI is not just image recognition for diagnostic capability. It is the back end, capturing the work, putting it into a charge master, and facilitating payment and the correct payment. What was really eye-opening, and I know EY's health service team does this, they look at quality of, you'll do a coding audit and then quality of earnings for assets, for medical assets.
Yep.
9 times out of 10, you are undercoding. And what that means is, the procedure should have been $1,015 and you're billing for $750. And it's consistent every single day in medical facilities because it's so error prone based on how complex our CPT codes are. So I think that's not sexy clinical innovation, that's operational innovation that I think is low-hanging fruit right now for a lot of the companies that are entering the AI space with imaging technology.
And maybe just 2 other anecdotes. Here at the conference, I had the pleasure of having dinner last night with the entire AVIMed digital crew that's working on FDA approval, guidelines for AI, and also CPT and reimbursement codes. And 3 years ago, this didn't exist. This was a committee that was just getting off the ground. Now they're guidelines for FDA approval. FDA approvals are up. That's in our Pulse of the Industry publication this year, and now they're getting paid for it. So hey, we're getting paid for AI as a medical device or medical technology industry. And just yesterday, I also sat and observed Kevin Lobo, CEO of Stryker, acknowledge that they're going to be using a lot of this ambient AI, what's going on in the OR, what's going on in medical transcription, they're going to create a whole digital franchise. So, they'll have, neurovascular, they'll have peripheral vascular, and they'll have digital. And that's going to be one of their verticals, how to actually make money, revenue, whole P&L, whole franchise. And so I thought that was really telling of where medical technology is really going by one of the leaders.
And that'll be interesting because other than Intuitive, there's really not a digital native within medtech. And so to take that digital DNA and try and port it into an analog-based historical legacy company, whether it's Stryker, Medtronic, Edwards, J&J, they've had their challenges along the way. So final question, if we're sitting here at AdvaMed next year in 2026, what do we hope to see and what do we hope not to see? Scott, I'll start with you.
I'll be politically correct here.
Don't be, this is my show.
I think we have an opportunity to hear from some of the ASC executives. And I ran a forum last year with my firm where we interviewed ASC executives and what they want from MedTech. And it was really telling. It wasn't price contracting. It was help with service line extension. It was help with provider recruitment. Help them build their business. And the connectivity, I would suggest MedTech companies as a whole, their touch point with ambulatory centers is in RFP processes and in purchasing contracting. They're not sitting at the strategy level with the chief strategy officer, chief operating officer, and CEO. And that dialogue really needs to happen.
In fairness, though, to companies like Stryker and Zimmer, Ortho, we'll come back to Ortho, which we have to touch on. Stryker and Zimmer do take a consultative approach in the ASCs, and both of them have services all the way down to real estate with CBRE, and then Stryker, and then Gettinger with Zimmer. So there is some strategy there.
There is some strategy, and I would say the business case of orthopedic right now is phenomenal. If you look at those companies, Stryker, Zimmer, I would put Arthrax in there as well, they have the ASC religion, meaning they have invested heavily in services, value-add services to help ambulatory centers, help physicians, help hospitals and investors build ambulatory centers. If I look right now at higher acuity, cardio-cath centers or soft tissue robotic centers, that's white space right now, and I think it's for looking at what's been successful in orthopedic, and one of these companies is going to do it first, and I would suggest it's probably not going to be one of the incumbents.
John, what do you hope to see 2026?
Yeah, what I hope to see, we had an M&A panel yesterday. One of the themes that we alluded to in our Pulse of the MedTech industry is, M&A is a vertical that can be leveraged. In that, Stryker example, Vocera and Care AI were two of the bedrocks of their digital strategy. We heard in our M&A panel yesterday that we expect more digital and more technology-based M&A. So I hope we come and see some of that really bearing, fruit. What I personally hope we don't come and see is some disruption in the capital markets. Up and to the right, day after day, feels a little uneasy, and so it's highly concentrated. So that could be really disruptive to capital markets, which ultimately has an impact across MedTech. So I hope we don't see that.
Yeah, as the markets go, look, we made it through the tariffs, and we're not on the other side of it, but at least all the cards are turned over for the most part.
Yeah.
Right? We don't like surprises. We've got the geopolitical issues we're dealing with as well. They're not likely to go away.
Not everyone else has flipped their cards over.
Not everybody else has flipped their cards over, right? But we're seeing more cards in Q4 than we did at the end of Q1.
For sure.
But we're just hoping that we don't turn over a joker sometimes between now and middle of next year, because coming into 2025, I, for one, thought 2025 was going to be a golden year for MedTech, and everything was trending, whether it was administration, sort of getting out of the COVID sort of hangover. But I think 2026, we're seeing the uptick in our business as well, very rapidly, coming into Q4. So I hope we're seeing it in capital markets outside the Magnificent Seven, and we get to see the MedTech stocks start to ratchet up again to the right.
Great.
So gentlemen, thank you so much for spending time.
Thank you, Joe.
Always
a pleasure.
Always, thanks. I'm Joe Mullings from the floor of the MedTech Conference, San Diego 2025. Be well.